Did you know some money market funds and even mutual funds, some of the dividends are not taxable at the state level? Are you paying more tax on the interest and dividends from your money market and from your mutual funds than you should? I've got what to look out for and how to avoid paying this extra tax. I got that and more coming up. One of the confusing things, one of the many confusing things about your investments and taxes is that interest on U.S. Treasury obligations, U.S. government obligations, obligations like Treasury bonds and those sorts of things, it's taxable at the federal level. It's issued by the Fed, but taxable at the federal level, but mostly deductible by many states. It's mostly deductible by many states. This is counterintuitive. You would think that a state is going to tax it. It's interest from the government. And if you're going to get a deduction, it's on the federal level. No, it's actually the opposite. It's taxable. So a Treasury bond, it's taxable at the federal level, but most states deduct it and it's not taxable at the state level. Very bizarre and maybe something to consider. If you haven't infused this as part of your planning, if you weren't aware and maybe you've got some extra dollars in cash reserves that are sitting in a money market, or maybe you're buying CDs, maybe if your state qualifies and this is deductible on your state's income taxes, maybe consider treasuries. That's one thing to be aware of. Work with your CFP on that. But that's Treasury bonds. That's Treasury obligations. Certainly money market funds or even other mutual funds, well, those are all taxable, right? Maybe not. Maybe not. Some extra work that you need to do every single year for your taxable investment accounts is to confirm whether the dividends or interest from your money markets and from any of the funds that you have are actually attributed to U.S. government obligations, and therefore you get to deduct. You could deduct some of that dividend, some of those interests on your state's tax return. Think about it. When you own a mutual fund or even a money market fund at your brokerage account, you own the fund, but underneath the hood, there's a manager that owns a lot of different securities, and you can't see all of them. You know, they might own Apple stock, they might own Nvidia. If it's a bond fund, they might own some corporate bonds, they might own some U.S. Treasury bonds. You can't see it, okay? But they're all managing it. That mutual fund owns a lot of individual securities underneath it. Well, if some of those securities are U.S. government obligations, and therefore your mutual fund is receiving interest on U.S. government obligations and then passing along some of that interest to you from the fund via a dividend, technically that should be sort of a pass-through where you get to deduct some of that interest, right? Yeah, and that's exactly how it works. But it's not going to show up like that on your tax form. It's not going to show up like that on your 1099 from your brokerage company. You actually need to do the legwork yourself and manually deduct, get the deduction on your tax return. Keep in mind, this is only for taxable investment accounts. So your Roth IRA, your 529, your HSA, those are all tax sheltered and for good reason. But what we mean by tax shelter is all of the interest, dividends, capital gains, none of that from those accounts that is generated throughout the year, none of it lands on your tax return. It's all sheltered from tax. So this only applies to your non-tax shelters. So your taxable accounts, things like an individual account, a joint account, a trust account, a brokerage account, okay? So where you're owning things not inside of an IRA, Roth IRA, 401k, something like that. Only applies to those. But then it only applies to certain funds. You've got to look at, well, for wherever your brokerage account is, whether that's Schwab or whether it's Vanguard, whether it's American Funds, whether it's Fidelity, you have to go to their website and look to see, well, how do I determine for these funds that I own whether any of the dividends or interest is attributed to U.S. government obligation so that I can deduct it? Here's a sample. This is the one from 2025 from Fidelity. And you can see right here on the front page that it says, what this is, that this document shows the percentage of dividends from our various funds, the percentage that is attributed to U.S. government obligations, and then it even shows you a calculation. For this much dividends, if you see, for that fund, this is the percentage that's attributed to the U.S. government obligations. You do the math, that percentage times the amount of dividends. This is the amount that is deductible on your state's tax return if eligible. And even in here, there's an asterisk showing which states may not be eligible for any given fund. So if you scroll down to the Fidelity Government Money Market Fund, that one is fairly obvious. You might think, well, this is a government money market fund. I wasn't aware of this. I am now, and therefore all of that interest should be deductible on my taxes. Sadly not. It's only 56.77% of the interest or dividends from the Fidelity Government Money Market Fund is actually deductible for, on your taxes, on your state tax return, okay? What about a bond fund? The Fidelity Flex U.S. Bond Index Fund, you'd think, well, that's corporate bonds, right? None of that is going to be attributed to U.S. government obligations. No, 44% of it is. So the point with this is do the research. You've got to figure this out, because on your 1099 that you get from your brokerage account, it's going to show you all of the interest. And it's going to report it both to you and to the IRS that it's all taxable. I mean, so every single year, thousands of people pay more tax than they should because they're not aware of this exception and they can't find the information and they don't do this math and they don't document it on their return that, yeah, my 1099 showed that I had $1,000 of interest from this particular fund, but 57% of it is actually attributed to U.S. government obligations. Therefore, that is a deduction, and the net amount I'm going to report on my tax return is the difference, and that's the only portion that'll be taxable on my state tax return. So, do you have a taxable investment account? If you do, and you've gotten your tax statement, your 1099, don't just assume that all the dividends reported on there are officially taxable both to Fed and state. To Fed, they will be, right? But to the state, make sure that you figure out, find this document from your brokerage company and double check to see if any of that dividend is attributed to U.S. government obligations and document that deduction. The good news, working with a certified financial planner and having them doing your tax planning, helping you with your tax preparation as well, they should be doing this legwork for you. So work with your certified financial planner on that. I don't want you to pay more tax on your income, on your money market income or mutual fund income than you should. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, y20show.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.